I would like to introduce our next guest, Daniel Bergstresser. He's an associate professor of finance at Brandeis International Business School. He earned a PhD in economics at MIT and an AB at Stanford. His research focuses on municipal finance and on the impact of taxation, regulation, and market structure on financial markets. In 2006 and 2007, he worked for investment manager Barclays Global Investors in London, serving as head of European credit research. Prior to graduate school, he worked for Federal Reserve Board in Washington, D.C. Please welcome Daniel Bergstresser.
So could I get can you guys hear me okay? I'm going to try to load my slides up. Let's see. I have my slides on a different document. Make sure this works. Is there anybody who can't hear me okay? Can you guys hear me just fine? So yeah, as I was introduced, I'm Dan Bergstresser. I'll say one thing about my career history and how it leads me to give this talk here. I did spend some time on leave from my academic appointment where I was serving as head of a group that was trading credit, actually, in London. And during that time, I became just absolutely obsessed with the question of where all the risk was going. You know, think like what are there? Seems like there's some vacuum cleaners out there that are just sucking up all the risk. Where is it coming from and where is it going? And that insight set me on a path of research that has led me to do a lot of work over the last 5 years, focusing on state and local finance, actually municipal finance. And so my talk today is going to be a little bit broader than what was advertised, but I want to talk about a bunch of different ways in which the alternative sector interacts with the state and local sector in the United States. Ways in which the state and local sector is important to think about as an investor in your funds, as an investment opportunity for your funds, and as a partner potentially for work that you might be thinking about doing, in particular in infrastructure projects, where private equity firms are becoming potentially quite important on that front. And so that's the theme of my talk today. Let me see, does this? Is there a trick to how you advance the slides?
I think you maybe just have to
Click. Got it. All right, so what we think of, and this is some background, a lot of people think about the government and they think about the federal government. And I almost say government there. It's the government. But if you look at what the federal government does, basically like what they do to a first approximation, they have an army, so they're out there, blowing stuff up. And then they just give a bunch of money to old people, either through the Social Security system or through Medicare. Like that's really what happens at the federal level is those two activities. And then they run a National Park Service. Occasionally they'll enforce some securities laws. When somebody looks like they get out of line, they'll put them in jail. But if you think about all the things that we think of as being, really what makes our society, a lot of that is done at the state and local level. So if you drove on a road to get here, you crossed a bridge to get here that you kind of hope stands up, or in particular, when you drink water from the tap and you sort of count on the water not having chunks of poo in it, that is activity that is a consequence of the state and local sector. So here's some tap water. This is kind of what it looks like if you don't have proper sanitation. These kids are the same age as my kids. I'm confident that there's a latrine somewhere within about 50 feet of the water that they're washing their stuff in and drinking. And it was, people visiting in the United States 100 years ago were absolutely astonished by the fact that we didn't have chunky water. I mean, it just blew. If you read the reports of travelers, they said, it's just a fantastic thing that you can drink the water from the tap without dying. You don't all get cholera and whatnot. And you could say, well, it's just sort of this magical thing about Americans that our water is clean. But it's a consequence of the municipal improvements, the fact that we invested in a great deal of infrastructure in order to make the water clean. And a large part of how that works is actually through borrowing. And I'm enough of kind of a thrifty Pennsylvania Dutchman to have a little bit of an intrinsic aversion to borrowing. But in the context of infrastructure investments, it makes a lot of sense. So if you don't have a credit market, then what happens is you've got your folks here, you've got your workmen, do I have a laser pointer here? Does that, yeah. You got these guys. These guys are paying taxes all the time. They're working. So this is what you have without borrowing. If you have to do it pay as you go. So these guys are paying taxes, drinking terrible water. You know, when they pay enough taxes, finally you get to build a water filtration plant, 30 years down the road. These guys are probably dead, potentially of cholera by that point. Their children get to reap the benefits of the taxes that they paid. But if you can actually borrow to do the types of infrastructure investments, then it makes a lot of sense in principle because it aligns the people who are benefiting from that infrastructure, right? So these guys here, our friends who are working, they get to benefit from the infrastructure investments that they pay for, and they pay for it over their lives in the form of the debt service on that project. And so a lot of times it kind of comes up, why is it that the state and local sector in the United States is so heavily indebted? Like what kind of profligate country is this where places borrow? But in fact, there is an extremely sensible rationale in terms of the alignment of who benefits and who pays to funding infrastructure with debt. There's some alarmists who have come through recently and said, Meredith Whitney is one. She says, it's all a house of cards. California is really no different from Greece. So here you sort of combine the Greek flag with the California flag. You create something that looks really pretty alarming when you look at it too long. And the question is California Greece? And the answer is just absolutely not. I mean, that is absolutely ludicrous. And these are some numbers from Gabriel Pedek at Standard & Poor's. And there are some things that you have to understand about these numbers. But just back of the envelope, look at Greece. Greek deficit, 7% of GDP. Their debt, 160% of GDP. They're having to roll it over all the time. The California deficit is small as a share of GDP. Their debt, as measured by S&P, when they're looking at the official debt, is really quite manageable as a share of GDP. But there is an important caveat there, right? And the distinction comes in terms of pensions. And now this is leading us into something that you need to think about as you think about working in the alternative investment space, because it's really driving a lot of the state and local endowment. When we were talking earlier about why is it that institutions are so excited about investing in the alternative space. So bear with me for a sec. Pensions are like borrowing from your employees, right? So if you consider the following thought experiment, you got a teacher, you have a cop, you can borrow some money today to pay him $20 an hour, or you can pay him $10 an hour and then promise them a generous pension when they retire, right? And presumably there's some amount of pension at which the worker is indifferent between those two things. And so the pensions create a liability, and it's, you could think of it as if when you have a pension, instead of borrowing money from the capital markets to pay your workers a higher salary, you borrow money from them and you pay them a lower salary, and you pay them when they retire. Now, the important thing is that the value of that liability depends on the discount rate that you value the liability at. So if you make a promise, right? So if I make Nikki a promise to pay her $30,000 in 30 years, the value today of that promise depends on the discount rate between now and then. So if the discount rate is 0%, that promise today is worth $30. If the discount rate is 9%, that promise is worth $2,300. And there's something really astonishing and goofy about the way that when state and local governments value these liabilities, they're valued. And this is the whole, right? So across the board, when you say, what is it that's, how is it that state and local governments borrow? In general, when they borrow, they're borrowing to build infrastructure. And the one exception to that, or the big exception to that, comes in terms of their pensions. And this is something that my colleague Josh Rao, Robert Novi-Marx have been focusing on, and I think trying to draw people's attention to. And I think it's important as a taxpayer to draw your attention to this. So the accounting rules let public pensions value these liabilities using the expected rate of return on the assets, right? Which doesn't make any sense. Like there's no reason why it should be that way. It is just these are the way that the accounting rules are set up. And so shifting a pension plan on the asset side towards a mix of assets that has high risk and high return makes the plan look better funded today because you increase the discount rate at which you're discounting those liabilities. And it's totally an accounting effect. It just, all of a sudden we're better funded than we were yesterday because we shifted the asset mix towards stuff that has higher risk, and then the accounting rules let us say that the value of our liabilities is lower because of that decision. And when Josh Rao and Robert Novi Marks are talking about this, they talk and they talk and they talk about this, and eventually they stopped getting invited to conferences where state and local folks will be. You got to stop. You're hurting our feelings by talking so much about this. Like, can't you find something else to talk about? Now, there's kind of an analogy to this old debate. 15 years ago, people were talking about expensing options, where you had serious corporate executives who said, if we really have to acknowledge the cost of the options that we're granting ourselves and our workers, this entire capitalism thing really isn't capitalism can't work if we have to acknowledge how much these options cost. And there's kind of an analogy here. We say, this problem is so big that it's just better that we not think about it, is the advice that people are giving Josh and Robert. So here, and then this is in the background when you're thinking about the question of what is the investment mix and what is driving some of the flow of assets into the alternative space coming from the state and local sector. So if you look in 2002, and these numbers are from Wilshire Associates, you see so pension plans are huge. For one thing, you're talking trillions of dollars. And a large and growing chunk of that is moving towards the alternative space. So the total in alternatives in 2001 was about 7%. Now it's about 25%. And part of what's driving that is, I think, a legitimate desire for returns in terms of you always want high returns. But on the accounting side, there is this problem, whereas you shift towards something where you can justify a higher rate of return assumption, you make your plan look better funded. And it's just it's an ephemeral sort of accounting game. Now, people say sometimes, aren't these state and local plans that move towards alternatives? I'm painting with a broad brush here, and I want to say some things to clean that up in a sec. But people will say, aren't these plans just following the endowment model? And you can say, oh, it's just the endowment model. It sounds really sensible. We sort of like endowments. Bill Gates has an endowment. He seems very smart. And it's not quite. And the reason is this. Endowments cut their payout if the assets underperform, right? So if you have an endowment, so the Gates Foundation, if they invest in a bunch of stock, right, or if they invest in alternatives, and those assets underperform, then less money goes to the things they support. In the state and local pensions, the liabilities are fixed, right? So it's not like the liabilities are smaller in value if the assets underperform. And so saying, well, this is perfectly sensible, just the endowment model applied to the state and local pension sector, that is really pretty problematic. And the question is, what is going to get cut in a crisis? Is it going to be the benefits to the retirees? Is it going to be maintenance on water systems? It really could be anything. But I would say keep an eye on the water and just get a filter. So given the way the accounting works, we need to think separately about the investment strategy as kind of a driver of value on the asset side versus something that is just allowing gimmicks on the liability side. And so with the liability structure that is fixed, it's important to see that in a conceptual sense, that the baseline strategy is a bond portfolio whose risk characteristics match the characteristics of the liabilities. And then you can say, well, we have a view that you layer on top of that bond portfolio. And here's where I think actually alternatives, especially hedge funds, as Roger was talking about earlier, if you're thinking about something where you're really adding alpha, right, starting with a baseline which is matching the risk exposure of the liabilities, which is a bond portfolio, and then layering on top of that real alpha. And where alpha coming? People debate. Is alpha coming from ability to hold liquidity risk, which is where I think a lot of it comes from? But that is a natural habitat for state and local pensions. If you say, if alpha is really compensation for the willingness to have your money tied up, then a really sensible strategy is actually matching the overall risk profile of your liabilities and then searching for pure alpha that has been stripped of beta. And in that sense, I've knocked this over 5 times, I'm just going to throw it over there. In that sense, actually, you have to think carefully about specifically what type of alternative investment it is. And in terms of mismatch of the risks on the liability side and on the asset side, there are some cases where stuff that looks really pretty vanilla. I mean, you can imagine somebody saying, we have a perfectly vanilla pension plan because it's invested entirely in the S&P 500 index funds, which is as vanilla a product as you can imagine. But that's extremely risky because of the mismatch of beta. Like the overall risk exposure is really mismatched. And it's in many ways much less risky to start with, to work with a bond-based exposure to the systematic factors and then layer alpha on top of that, although it might look more like something that is exotic. Okay, so the problem is beta. There really is a great rationale for alternatives in this context, but it's important to think about what is the alpha and then what is the beta in the alternative part of the portfolio that's being layered on. So I think when it comes to private equity, private equity universe, I think, has a lot of beta. I mean, that's buying a lot of value companies, adding some alpha, doing the hard work of turning companies around. But that is, I think, undoubtedly more of a beta exposure than what you have in somebody who's really doing the type of work that Roger is describing in that zero beta fund. And again, the numbers here are really quite large. And the thing that I would want you to take away is, as you go forward to your careers in the alternative investment space, it's important to be aware of the context, right? The context here is that there is a historic problem. Like there is a problem of really historic magnitude that we're not really acknowledging, which is the problems that are introduced by the goofy accounting rules that we have for valuing the liabilities on that side of the balance sheet for these pension plans. And one earlier example that I can think of where you've had just such a determined such a strong political determination to avoid facing up to a problem is the savings and loan crisis, which, 1979, I think everybody recognized that the savings and loan industry, the entire industry, was massively underwater, right? So all of the market value of these firms was negative. I said, this is a problem. Like we could step in now and sort of clean up this problem, but it would be incredibly painful, and we would get blamed. We would be the ones who got blamed. Why don't we just see if it works out? Like, let's just sort of see what happens. Let's let it sort of kick down the road a couple years, and maybe it'll get better. And what happened is, the SNL sort of went to they're underwater, and so it was kind of a tails you lose, heads I win scenario, and it was really off to the races. And so I'm concerned. I think that there is cause for concern here, and there's cause for concern both as a taxpayer and really as a drinker of water, because you have to ask the question, like, what is it that happens if you really suffer there, and do we lose some of the things that we've developed over the last 100 years, and some of the things for which we're famous internationally? Like people, we have had fantastic infrastructure, and it's one of the things that makes it possible to do business in this country. So and another thing to take away is that things sometimes that seem really boring and vanilla are actually, depending on the context, high risk. So in this context, the S&P 500 index fund, that product is actually extremely risky in the context of the beta exposure, where the payoff, if the markets really fall, then we have to make it up in terms of increased taxes or lower delivery of services. And that is a state of the world where we're already, suffering, where the economy is already bad, and on top of that, we're having to pay higher taxes. So I'm going to change gears a little bit, and I'm going to tell some what I think are kind of interesting stories about how. So before we're talking about municipalities, state and local pension funds as investors. Now I want to talk about it as an investment, and the background here is. One of the things you like to do, as Americans, I think, feel like it's a God-given right. We want to lever up everything. And it's difficult to lever up municipal risk, but not impossible. And I think there are some lessons from the experience of hedge funds that did this over the last 10 years. So this is, if you look historically, municipal bonds just don't default. I mean, I realize we're on tape. I'll probably regret saying that someday. But if you look at the default rates on municipal debt in the rated part of the universe, and you can't really see it because the scale is thrown off there. This is a 10-year cumulative default rate. This isn't even losses. Most of the time when you have a default, you eventually get paid in full. The AAA Muni stuff over 10 years, like 0 defaults, AA, single A, you can't even see it because it's so low. You get out here and you start seeing some defaults. The blue line is the municipal default frequency over 10 years, and the orange line is the corporate side. And so these numbers come from Moody's. And if you look at if you buy a single B-rated corporate bond, over 10 years, your default probability, your default rate in the sample was 40%. On the municipal side, it was about 16%. Here's what it looks like when you throw out the C stuff, and so you can focus on where the scale has some meaning, and you still see. I mean, this is 0.13% historically. You see incredibly strong credit quality in the rated part of the municipal sector. Now there was a neat report by the folks at the New York Fed where they said actually if you look at the entire market, including the stuff that is not rated by the major rating agencies, then you see higher default rates. They said defaults are much higher than advertised because there's all this stuff that is not rated where you do see some defaults. And I think that is absolutely true. And the analogy that I would use is kind of like a neighborhood or a city where there's no crime, except there's one bar, and everybody who goes in that bar gets murdered. But there's no crime anywhere else. It's like, is that a safe city or is that a risky city? Just don't go in the bar. And that bar is, it's like Florida speculative development where they're kind of building sewers in advance of the city that they expect to get there, right? So there's no city there yet. They're kind of build the sewer there and hope that a city, like, oh, you got a sewer, let's build some houses. And that stuff you do see some defaults, and the rating agencies won't rate it, right? Which is why you don't see it in this scale. Now, that's Elliot Spitzer. One of the funniest parts of the financial crisis, I mean, it was just fantastic. It was almost, if you were to make this into a movie, you would say it's not plausible, like it can't happen. The Congress had hearings sort of in sequence. Like the first hearing, they brought in the rating agencies to beat them up about the ratings that they assigned to their structured products. They said you call these things AAA, you call these things AA, and then they default, and your rating scales are totally out of whack, and they beat them up for having rating scales that were too generous or too optimistic. And then a couple weeks later, they sort of called in the rating agencies, and they said, you have this rating scale, it's totally out of whack, you're calling this stuff triple B, and it never defaults. And so this is causing all sorts of trouble. Like, can you just be less stingy in your rating scales? And they sort of did this. I think being a congressman is probably like being a defensive back. You have to have no memory. You just got to be right in the moment, kind of right there. And one of the folks who testified down there, and this is people in the muni industry really were impressed with the aggressiveness with which the governor of New York kind of bullied his way onto the program. So I really want to testify on the municipal rating problem. This is kind of the press release. And people at the time said, doggone it, why is Elliot Spitzer so just enthusiastic about coming down to Washington to talk about muni bonds? I mean, most people would cross the street to avoid that. But yeah, there you go. Oh boy. Take a drink of water, Elliot. So people have kind of noticed this, and Elliot Spitzer noticed it before he got distracted by other stuff. It's interesting to kind of ask the question, so George Washington, right, was a historically important figure, and Ben Franklin, and does history play out differently if George Washington dies of cholera, like in the 1750s. He's off there in the French and Indian War. If he kind of dies of cholera, are we British now? And I think with Elliot Spitzer, there is kind of I think things kind of play out differently if he's in the room and kind of not distracted by his personal problems. We kind of wonder what that history would look like, but we don't, it's speculation. We don't get to live that. So, okay, in any case, so people noticed the low default rate and high yield on munis, and the question is, can you build a hedge fund around, I say free, around this return that looks like it's compensation for bearing liquidity risk. It looks like it's compensation for something other than the risk of default on the underlying instruments. And yeah, certainly. I mean, you can build a business around that. Ideally, if 100 basis points for something that's not going to default is great, then levering that up is even better. I said earlier that the federal government doesn't do much. They do have an IRS. The Internal Revenue Service, they will stand in your way, right? So if you borrow a bunch of money to buy municipal bonds, they get kind of mad about that, right? Because you're getting tax-exempt interest coming in, and then you're getting a tax deduction on your borrowing. Now, it's every fund manager's kind of God-given right to borrow against the stuff in their portfolio. And so, where there is a will, there's a way. And this is important for understanding. In some ways, this was one of the sparks that started the financial crisis. And so what had been previously unleverable became, with a little bit of financial engineering, something that you could lever up. So what you do, the way that you do it is you take one, just throw it off to the side. What you do is you put a municipal bond in a trust. Now, you remember, you can't borrow against it, or else the IRS will get very angry at you. But you put it in the trust, and it's called a tender option bond trust. And then you issue out of that trust a senior claim and a junior claim. And if you've taken corporate finance, you'll notice that the junior claim all of a sudden is a levered position in that underlying municipal bond. And this was an innovation. They kind of invented this in the 90s. It took off. It was kind of gradually took off in the period leading up to the financial crisis. There's some additional work that you have to do. So the senior claim has a floating coupon, so the price stays very close to par. The coupon is reset weekly. And then you layer on a liquidity guarantee, so you can take the senior part and you can put it back to Citigroup, or you can put it back to Dexia or another bank. And so all of a sudden you have something where the senior part of the capital structure here is 2A7 eligible. What that means is that it's cash. It can be held by a money market mutual fund, right? And what that means is that the leverage for the municipal investment sector, if you say, how is it that overnight hedge funds that had never been a player in municipal debt, really, became a big part of the big vacuum cleaner that was sucking up risk in this part of the universe, part of the world. And it has to do with the innovation here, which allowed people to lever up their portfolios. And many times, the people who started these hedge funds, a number of them actually came out of the investment bank desks. So you had somebody who was doing this on the investment banking side to finance the portfolio that they had inside. And then they said, well, we can run a hedge fund around this idea as well. And you should think of this as basically, the lesson here is that you can try as a regulator to regulate the amount of leverage that a firm that you're regulating is going to take on, but it's extremely difficult to do. Because if you say, well, you can't borrow, people will come up with innovations that deliver the same economic result, are a little bit more complicated, comply with the letter and the, maybe even your interpretation of the spirit of the law that you have against leverage, but which deliver leverage. It's a devilishly complicated thing. And I'm not hostile to regulation. I've sort of outed myself as a guy. I like wastewater treatment plants. I'm clearly, like not a Tea Party guy, right? But it is just, it's hard to regulate stuff, especially when the people who you're regulating don't want to be regulated. Okay, so now the hedge fund has 6 times leverage on something that pays more yield than is justified by default risk, and so what can go wrong? And this is just a life lesson for everybody. If you're doing this in a hedge fund, so this is the Muni yield, right, is in blue, and the Treasury yield, it's a 20-year yield. I pulled it from the Federal Reserve Board, and you see the Treasury yield here, And some of the muni yield getting pushed down was driven by what they called at the time. They said it's the TOB bid. It's the bid coming from hedge funds is sort of pushing things out of whack. There's a huge demand for really anything that they can put in the product. And in retrospect, and this is the importance of what Roger was saying earlier today, always know, at least for yourself, whether what you're doing is alpha or beta. Right? So they marketed this as alpha. They said, we got a lot of alpha. We're doing, there was, this was, I would describe this as kind of an exotic beta. Like this was, you're giving people access to something. It's hard to invest in muni bonds. It's kind of illiquid, but there was very little security selection, like during this time period. It was just a big vacuum cleaner. Like, if we can get a bond, we'll put it into a TOB, we'll finance it, we'll make money. And there wasn't, what I think of as alpha, which alpha involves selection, like doing some, doggone it, alpha involves selection, like doing something and not doing something else, right? And there was very little of it going on here. And so what that meant, or one of the things that happened, is that, remember when we talked about the, so the senior claim can be put to a bank. So a bank has offered a liquidity guarantee, where the money market mutual fund who's bought this can sell it to JP Morgan. If they want to get out, they can sell it to JP Morgan or Citigroup. And what that meant was that you had, at the time, pretty cheap leverage for the hedge fund that was holding the junior claim. And all that Citigroup required was that the mark-to-market value of the assets in the pool be over a certain level. And that's any lender who would require such a thing. Like we're going to check every day and make sure that the value of the assets in the portfolio is consistent with the amount of leverage that we have supplied. What that means is that when you get here, right, you get liquidated here, right? At this point, right, when muni spreads widen, Treasury spreads fall, this is the trade of a lifetime. Like this is the trade of a lifetime, but you're done. Like you're out. Your hedge fund is shut down. You can no longer keep the hedge fund open, and have a drink of water. The spread sort of came back. It has since kind of drifted back up, and part of why it's drifting up, there are a lot of things going on, but one thing that is for darn sure is that you had so many fixed income arbitrageurs that got blown up here that the amount of arbitrage capital that's around to correct these inefficiencies is just, like all those folks are, doing PhDs in art history now. They're kind of not in the business of correcting these inefficiencies, even though, it really was and potentially remains kind of the trade of a lifetime. So the lesson is that even if you have the trade of a lifetime, and I think, in the context of the TOB hedge fund experience, that was the trade of a lifetime if you could hold on to it. You can't necessarily hold on to it. And there's one additional innovation that I want to talk about because, I myself, like you think you have this in your head, you have kind of a ranking of the sexiness of different things. And I'd say it starts with, hedge funds, kind of sexy. And, somewhere below wastewater filtration plants, you have the insurance sector, like, which you say, okay, insurance, incredibly boring. But I want to talk about a way in which these labels that we place on different sectors can be misleading about how interesting they can be. So consider the same trade where you're taking muni risk, you're putting into a hedge fund. Great, it's the trade of a lifetime, but you're dead. So let's imagine instead that you set up an insurance company and you insure municipal debt, right? So you just agree, okay, here you have a bond issuer. The bond issuer, you can't see the arrow, but the bond issuer is making payments to the bond investor. And you just set yourself up as an insurer. And you say, well, I guarantee, if I'll get, the insurer gets paid something when the bond is sold, and in exchange, they step in to make payments in the event that the issuer is not able to do it. Right? You say, well, why would anybody do that? Well, it's because they get paid. This is, if you strip away the labels, this is exactly the same as just taking the risk in a portfolio management context. Like you are taking the default risk of this municipal bond. With some important institutional distinctions that turn out to be vital. So assured guarantee insures $700 billion worth of stuff. And we talked earlier about how hedge funds were 6 times levered, and that was too much leverage because they couldn't hold on to their trade. Well, assured guarantee has $6 billion in capital on a portfolio of $782 billion worth of insured municipal and other debt. And they, at the moment, they have a AA minus credit rating. The reason is they only have to pay out in the event of default. Right? They get to hold on to their trade. Spreads can blow out, they can come in, and they only have to deliver capital in the event that you have a default. And so if anybody ever tries to tell you that, okay, you're going to work for an insurance company that's very boring, and your friend is going to work for a hedge fund that's incredibly sexy, I would say in your careers, try to strip away any notions that you have that are based on the labels that are applied to different institutions and focus on what they're doing. Now, anytime you're talking about bond insurers, you do have to acknowledge the fact that there were a number of bond insurers that managed, even with this sort of favorable business model, to blow themselves up. Right? So you had MBIA, you had AMBAC, and to that I would say that it's astounding that they blew themselves up, but here's what happened. They got out of the business of insuring this municipal debt, and they got into the business of insuring, tranches of CDOs and doing the more structured finance stuff. If you look just at the municipal part of the portfolio, you don't see the same type of trouble that you have on the structured product side. So there are some clouds on the horizon. So in general, to summarize what we've said, municipal borrowing is great when it makes water clean. We like it. California is not Greece. There is this problem with pensions. Right? There's a huge accounting problem, and it drives some of the flow of assets into the alternative sector. So just be aware as you're out there, like you're doing a job, and you should always have this little thing that goes off in your head. Like, am I a jerk? Like, is what I'm doing kind of bad for society? It doesn't mean and I would say that if your job, wherever you are, is helping folks game sort of a crooked accounting system, then yeah, you're a jerk. Okay, some clouds on the horizon. Localities rarely default, aside from the Florida speculative build a sewer. If you field of dreams, if you build it, they'll come. States don't default. There are some exceptions that I think drive home the rule. So Arkansas defaulted in the 1920s. They eventually repaid in full. You had a wave of defaults in the 1840s. So in the 1830s and 40s, you had one state. It was like an episode of The Simpsons. You had one state build a canal. It went really great. Then every other state's like, we're going to build a canal too. And it just doesn't work. Like, you don't need all these canals. You kind of need one canal. And so you had a wave of defaults by states. Most of the states eventually paid back in full. And the reason why they paid back in full is that they wanted to be able to borrow again. And it's an astounding thing in economic history because one explanation for the high credit quality of American municipal debt is that it is held by local people. So Boston bonds don't default because they're held by Boston voters. And there is some truth to that. But this debt in the 1840s was held by the British. Like it was held by international investors, and it still got paid back. And Bill English at the Fed has a fantastic paper on that. It's the states that paid it back, they wanted to be able to return to capital markets. It's interesting, given that history, to think about a situation that I've been working on. I've written a sequence of cases on. So Jefferson County, Alabama. It's the biggest county in Alabama. It's a super important county. Birmingham is there. They have had for 150 years. They've had a hard time with having human waste in the water. And you just read the history. It's like, well, in 1873, 60% of the people died in the cholera epidemic, and we just can't get the water clean. And eventually the EPA stepped in. And the EPA said, even if it doesn't bother you guys, the people who are down the river from y'all are getting really annoyed about the chunky water that y'all send their way. And so they said, you guys need to do something about your sewer system. And then it was off to the races. And I said, oh, my goodness. Of course, yeah, let's do something about the sewer system. And the other, it was the drinking water. The EPA consent decree came. You had a lawsuit filed by, it was people who liked the boats. There was the boating community was offended by the waste that was coming in the river from Jefferson County. So there you go. So the cholera epidemic of 1873. This led to $3 billion, the EPA consent decree led to $3 billion worth of borrowing and spending. And a lot of it was pretty misguided. I mean, they did some just astonishing stuff. I mean, for one thing, you're doing a $3 billion upgrade plan, or I think it was planned to be a billion and change. And they didn't put any resources into planning, right? Like, how are we going to spend this money? Like, we're going to borrow a bunch of money. We're going to, in some vague sense, sort of upgrade the sewer. And they ended up just doing the goofiest stuff. They tried to dig a huge tunnel under a major river to send the sewer. They called it the super sewer. We're going to build a super sewer, and it was going to a place where nobody lived. Some developers had bought land out there, and they kind of hoped that, well, you put a sewer there, and then our land will be worth more. And eventually, like the Army Corps of Engineers stepped in. They said, you'll kill us all. If the river breaks through and floods your super sewer, like you'll all die, and it will be incredibly expensive to clean up. And so, well, okay, it was a nice thought. And so there was a lot of bungling. You can ask, well, how is it that they had $3 billion worth of borrowing? And then they did all sorts of, they would borrow using floating rate notes, but then they would convert the risk exposure using swap contracts. So you'd borrow with a floating rate note, and then you'd enter into a fixed floating interest rate swap, so you have a fixed rate exposure. Now, how is it that they ended up having $5 billion worth of swaps? And so part of what happened is that they entered into swaps, and then they entered into restructuring swaps. And one thing that you can do with swaps is you can actually embed a little bit of borrowing in swaps. Like the Greeks had this figured out. You say, how in the world were the Greeks able to fool the EMU into thinking they didn't have any debt? Well, what they would do, part of what they did is they said, well, we'll enter into a swap. I'll give you Deutschmarks, you give me dollars, and the terms of the swap were kind of off market, right? Where, I'm giving you more money in the future, but you pay me a little bit up front now. Right? And it's a way, it's not labeled borrowing, but it's a way of getting some budget relief today. And it's the economic substance of it, just like in the tender option bond program. The economic substance is borrowing, even if it's not labeled borrowing. And Jefferson County was doing a lot of that. Like they would come to a point where we need a little bit more cash, let's restructure a swap. And it's just a swap restructuring, but you're getting paid for it. So there's some embedded borrowing in that. They eventually filed for bankruptcy protection. And this is, it's troubling, right? Because kind of most of the time when a municipality files for bankruptcy protection, they're kind of apologetic. They're like, oh my goodness, like, how can we just need to restructure, how can we pay you back? Like we just need some time. In Jefferson County, I think it's the novel kind of legal argument, like we just don't have the money. We're not going to pay you. Like that's what we're going to do. It's just not give you the money. I mean, we borrowed it. But yeah, we're not going to pay. And the folks at J.P. Morgan are, they are in a little bit of a pickle because they certainly, it was a very complicated process. Like the political, like how you got awarded a swap deal, there were some bribes. Like bribes got paid. Bad things happened, and it looks like if you look at the terms of the swaps. And this is something you see just again and again. Whenever somebody is really in a pickle and they need to do something that is borrowing, but it doesn't look like borrowing, they're willing to accept terms that are a little bit unfavorable to them. Right? And so the terms of these swaps were kind of more favorable to the counterparties. But then what happens is, on these swaps, they owed J.P. Morgan $750 million that then J.P. Morgan sort of tears up that debt. And you say, well, was enough of a premium built into these swaps to make it a sensible thing? Like they should have had more premium built into these swaps in order to compensate them for the risk that was embedded. And it is, I don't know what's going to happen, right? So the bankruptcy process is kind of working its way through. I think the biggest question is what's going to happen. this is a sewer system that is rapidly deteriorating. Like, so they had the state-of-the-art sewer system 10 years ago. It's not being well maintained because they don't have any money, and they're not willing to raise taxes they can't raise taxes to pay for it. And so it's deteriorating. Eventually, I just like that look. That's that's food for thought. Like, take that with you too. Eventually, they're going to have problems with chunky water again, or at least the people downstream. And so it is cause for concern. Like, if you refuse to pay people back, you're going to find that it's hard to borrow again when you need to borrow to fix up your sewer system. Now, the last thing that I want to talk about is one thing that, again, when we think about improvements to water systems, one thing that is, and in general infrastructure, one of, I think on the horizon, is a deeper degree of involvement of the alternative sector in that process, right? So in taking over, managing the risk of infrastructure projects. And there's a recent deal that I think is pretty innovative. So the city of Bayonne, New Jersey, their municipal utilities authority recently signed a deal. So this is December of last year. So it's 4 or 5 months ago with KKR and United Water. And what it is they continue to, in a legal sense, own the infrastructure of the sewer system and the wastewater system. But they signed a deal with KKR where KKR and United Water will run it, right? And so the deal, everything gets kind of negotiated here. Like, what are the parameters around the charges that we're going to have? What are the parameters around the capital that's going to be put into the system? And so part of the problem, I mean, you can look at it from the perspective of the municipality. You've got a system. It is deteriorating. You don't have the money to fix it. Like, you don't have the money to do the capital upgrades. And so a deal like this is potentially very attractive. And in the announcement of the deal, they say there was a $150 million upfront payment, which should always, I think, set off some level of concern in your mind. Like, why did there have to be an upfront payment? Like, if the terms of the deal are set right, then maybe you could do this with no upfront payment. And so embedded in this deal is a certain amount of borrowing. Like, this is embedded, but maybe not recognized, is a debt of $150 million that is baked into the terms of the deal that they've been signing. Because otherwise, why would they get $150 million up front? Like, unless, I mean, these guys are not idiots. Like, there's got to be value there. And KKR has agreed to put in another $157 million. And here I want to give you just kind of a word of warning as you go forward into careers here. And this is, I think that there will be some cases, and you see this in the Jefferson County situation where the banks all show up, and you just get this sense that you show up in Jefferson County as a young banker, and they say, well, the way things are done here in Jefferson County is that things are a little bit like you pay people to kind of get the business, and that's just kind of the way it works. And the people who got involved in that, I think, end up, everybody wishes that they'd never heard of Jefferson County. Like, even the people who thought they were getting a good deal, they thought that Jefferson County was on the short end of the stick and they were on the long end of the stick. But everybody wishes that they hadn't been there. That's true of the banks, that's true of the insurers. And there is the potential here. I mean, when you're dealing with state and local authorities, you do at times have this asymmetric problem, right? Where if things don't work out, right, and you're the fancy Wall Street folks, there will be this situation where if it goes against the municipality, right, if the terms look like they didn't favor the municipality, in any arrangement, there is a certain amount of risk. Like, we signed a deal. Like, Nikki and I signed a deal. Maybe it goes your way, maybe it goes my way. But there is this potential problem that when you're dealing here, that 10 years down the road, people say you took advantage of the inexperienced staff of this municipality, and God forbid, like, heaven help you, if you did anything other than adhere to the strictest standard of ethics, because that makes the risks really, really one-sided. And I think it's possible at times in finance. I had this sense wherever I've taught. I have this sense sometimes that people think, ethics things that are taught in an ethics course are not essential to finance. But I think you cannot separate ethics from finance. And as you're thinking about deals like this, I think they're fantastic deals. I think a lot of municipalities can benefit from having bringing in outside capital, bringing in experienced operational management. But if you're doing that, if you're in this business, and there's something in the back of your head, like imagine that you're competing with KKR, and you think, well, KKR has the lead, and if we're going to compete in this space, we got to be Avis, we got to be a little bit more aggressive. Like we're second right now, we got to jump to the first tier. If there's something in the back of your head which is saying, am I a jerk, or like, am I going to, if people find out about this, are we all going to go to jail? You should listen to that. Like that's something that you should really think about when you get that feeling. Like if this were on the front page of the Birmingham Post, or if this were on the front page of the Boston Globe, would it be a problem? Like would I be able to go to pick up my kids at daycare without a bag on my head? And if the answer is no, then that's a problem. And there are a lot of jobs. Like you can, I have friends who have left jobs before they went down paths like this, and nobody is sorry. Like nobody is sorry that they said early on, this isn't going in a direction that I like. I don't trust my boss. I don't trust what we're doing here, and it's time for me. Even however complicated you think your life is, like you may be, your wife's got a brain tumor, you just had kids, you wrecked your car, you need the money, you can't leave this job. There are a lot of jobs, but you have only one life, and so you have to be careful with what you do. So that's it. I want to conclude, and thanks for sticking around. This is fantastic. I'll stick around to answer questions. I have no idea what time it is if I've used up all of my time. How much time do we have? Sweet. If you have questions, but I'd say in general, keep an eye on the state and local sector because they will be investing in your funds. And I think the rationale for public pension investments in alpha is extremely strong. Like, there's an extremely strong rationale there, but don't be a jerk. Like don't mislabel beta as alpha, and know what you're doing. As an investment, I think that there are very interesting ways to invest in municipal debt. Don't get attached to the label. Like don't think, okay, this insurance company is boring, this hedge fund is exciting, because the label is just a wrapper. And in many ways, sometimes the thing that looks a little bit boring, there is value in things that are not necessarily sexy. And that was in Roger's talk as well. Like there's value in things that might not look valuable. And then finally, if I could say one thing, you think about Jefferson County and saying, we don't feel like paying the debt and we're just not going to do it. And, these things matter. And so a lot of times, especially people, when I was your age, I very rarely voted in an election. If it was a presidential election, maybe I could be bothered to vote. I had no idea who my city council person was. But this is very important, right? This is, if you think about what makes America America, like these decisions are made at the local level, and this is how we get clean water. Like this is how we get schools, this is how we get roads. And so beyond your careers, I think as participants in society, I think pay attention to this. So that's it. Thanks very much.